Hello, everybody. Welcome once again. This is Kevin Shortell, Director of Training for Note School, and we have a really good case study for you here today, which is going to be gone through by Mr. Eddie Speed himself with us. Eddie, how you doing?
I'm great, Kevin. How are you?
I'm doing excellent. I really like this case study because it covers a lot of different aspects. You know, seller financing is so popular today, but it's how do you structure it the right way? How do you paper it the right way? How do you create deals that can make above and beyond just a average profit, if you will? And in this particular case study, which you've done yourself, you're able to buy this with seller financing terms, in other words, and sell it. And before we get right into it, I thought what would be helpful for everybody watching this would be to have a better understanding of note investors are real estate investors, and I think that's overlooked many times. At least it has been with me. I'm sure you've had the same experience when people go, "Oh, you're a note investor." Well, note investing is real estate investing. So what's your thoughts on that, and what experience have you had on that?
Well, I think that, you know, both of our lives of doing the business have, you know, morphed us into kind of who we are. You know, I've been buying seller finance transactions from individuals that have sold property for dang near 40 years, right? So I've seen about every different way a buyer or a seller have agreed to a deal, because the seller then ends up with the owner finance note and shows up at my doorstep down the road and says, "Hey, I want to sell this." So I've seen a lot of different scenarios, a lot of creative stuff. I would say, I feel like, Kevin, you know, I think at some point when you have the combination in your head, then you can get creative, right? But I think initially what allowed me to be creative and think this way, and I think you too, is that you see all these transactions that other people have been creative with. I kind of like to say, you know, there's somebody smarter, the buyer or the seller, right? And so a lot of people have showed up at my doorstep where the seller has made the buyer has made a heck of a deal, right? And then so it just started making me realize that there was a market opportunity to really give people terms and really soften up effectively what you're paying for the property.
Right. Yeah, exactly. And you know, it's so great to see the creative aspect of seller financing coming back in. And I know that we spend a lot of time looking at the current market, what's likely to happen in the distant future, but what's most likely to happen in the near future, and really breaking those out, and what we call the niches, really. And I know we've done a projection on that. So I think I'm going to go ahead and turn my camera off here now, and that will save a little bandwidth, and we'll get right into this. And we'll start off here by talking about, I think, those niches, Eddie, because I know we have a lot of real, you know, we could show you the background of how we got all these numbers and where everything is going, but I think summarizing it right here would be helpful for everybody.
Well, one of the focuses that we're doing, and we call it, you know, the 6 biggest niches in notes for 2017, and it may have been the same thing in 2016, Kevin, but these are relevant plays in the market. And all of these strategies, obviously, is what we discuss, you know, in the 3-day class, and get to a good in-depth knowledge of each of those and case studies and stuff. And obviously we pick one of those today, and this is a real transaction that I did less than a year ago. And fact is, Kevin, I've cut a deal literally this week on 2 more similar scenarios. And so this is something that we do on a regular basis, buying property with seller financing. And this story today is about some dirt. So it's not about a house, but you could do it to a house. You could do it to a commercial property. There's nothing that says it had to be dirt. But I will say one thing that's important. This dirt transaction, if you make money buying a fix and flip, Kevin, because it, you know, you change the condition of the property. Well, if you buy a larger piece of dirt and you bust it into smaller tracks, you change the sales price of the property, right? The smaller the track, the more valuable. So we change the value of the property by breaking it into smaller tracks.
Right, but in that math, I mean, this deal certainly, I think one of the things that you're saying there is this could certainly have been a deal where you bought low and you sold high. Okay, and that's not a, what's that?
Yeah, we could have overpaid for the property.
Yeah, yeah, but you got to know, you know, how you can look at math differently, how you can raise the value of these things, and then even with that creative aspect you were talking about earlier, really make this into something special.
So the first thing is we're going to break this down and show you this case study, but here's what you're going to see the pattern to. Math other than buy low, sell high, right? Why being the bank is so good. So you're going to see that us being keeping financing on the backside really crazy changed the profitability of the deal, and then more creative than, I don't know. I mean, to me, it's like this deal architecting thing that we keep referring to. There has to be, Kevin, at least half of the real estate transactions you could change the profitability, change your exposure, change your investment in it, change your dollars invested in it, whatever. Like it's different combinations on different deals. But thinking this way is really not just what every note guy should know, but what every real estate guy should know.
Yeah, absolutely. And part of that is gathering information and understanding what the needs and wants are, and then understanding that there's the difference, you know, by adding in terms and adding and how that affects price. I mean, that really can open the doorway.
Yep. All right, so these are kind of the points that we're going to kind of unveil as we progress through this. So, Kevin, let's look at this deal.
Yeah, we got a couple pictures of the actual land. I'll click through those if you want to proceed.
Yeah, so this is you know, this is farmland. This is 135 acres. It's about it is about 70 miles from downtown Fort Worth. So it's pretty land, as you can see. It's real pretty. When you drive up on top of that hill, Kevin, and look out there. You know, just looking out at the countryside, it's like, wow, this is just pretty land. And so obviously that's what we're going to sell it for. We bought this land for $27.50 an acre. The person that owned it inherited it. I have a partner. I've done a number of deals with him, and he has done business with this lady in the past, and there was a good trust factor, and he's you know, structured this deal and done well. He and I kind of brainstormed together in some of these ideas and tweaked it, and that's now you'll sort of see what we did. So we paid $371,250 for 135 acres of land. All right, so this is kind of what it looked like. It was that road frontage of about 3,000 feet. There's a gravel road in front of it. They're about 3,000 feet, and Kevin, it's about 2,000 feet wide, 2,000 feet deep. So if you you walk from the front fence to the back fence, you'll walk about 2,000 feet. Okay? So when we bought it, the first thing we did is we bought it on terms. She agreed to seller finance it. So we financed $231,250. We paid $140 down, and then we financed $371,250. So it's actually $140 even, but everybody gets the point there. Yeah.
Yeah.
All right. So there's the terms, and at 20 years we paid 38% down, and because we made such a big down payment to her, we said, listen, we want you to carry it for 20 years, and we want you to do a couple things. We want you to release. Let's look at the land. We want you to release the amount we paid down. So the price per acre, the $140,000, she released 51 acres. It doesn't have a mortgage on it. Okay. You know, everybody understands what negotiation is, right? Negotiation is finding out what's important to somebody and meeting their needs. We negotiated with her, and she wanted a lot down, and we said, okay, if we do that, here's the conditions we want. She agreed to it. No problem. So then we created a note, and my partner's named David, so Eddie and David's debt, that's what we did, and she carried it, Kevin, at 0% interest.
Yeah, I clicked that a little too quick there, but yeah, 0% interest.
That's okay.
I'm sorry about that. You don't see that too often. I know that's going to be a little sticker shock from everybody, but tell them why you were able to get 0%.
Well, she agreed to it.
Yeah.
Well, I mean, listen, we're going to pay a big down payment. We want you to finance the rest of it. We need a pretty long time for you to carry the financing for us, and we'll pay this down if you carry it at 0% interest. And people like Kevin, that people have never done this, they're like, oh my God, nobody would ever do this. Kevin, I would say that half of the property I bought with seller financing was at 0 or 1 or 2% interest.
Yeah.
So
yeah, I think a lot of people don't ask enough questions to find out what their needs are, and then come back with some kind of a compromise that meets what they're looking for. And obviously, you know, she wasn't really interested in interest rate. She was more interested in the price, and you met that.
Yeah. Also, she carried annual payments.
They're
not monthly. So that means, Kevin, I get to go a whole year before I owe her another payment.
Right.
Just saying. All right, so let's roll this thing up here, Kevin. Here's kind of the debt and the structure of our buy. And here's her 20-year cash flow that we owe her at 0% interest.
Mm-hmm.
So those are annual payments, and the value in that, Kevin, is we're going to bust this land up and sell it, and we have the right to wrap the mortgage. So we have the right to resell it with owner financing, and but it's also very helpful if we sell these when we're selling these tracts that we're collecting monthly payments and we're paying annual payments. Does that make sense?
Yeah, big advantage there. Sure, you got money coming in throughout the year, and then you just have one lump sum due at the end of the year. So when you're selling these, you structured it like this.
Yep.
Or I'm sorry, that's my apologies. That's your payment, and
yeah. We used some math in this that shows like the net monthly income. So we had to divide. We had to come up with that number. That's all we did.
Right. So you're not paying, in other words, I'm sorry, I said that incorrectly when I started that. You're paying $11,562 per year, but to compare it on a monthly, we just divided that into 12 months. So you're not paying $962 a month. You're just paying $11,562 one time per year.
Right. But I used that math because as we progress into net cash flow, I needed to kind of make that point.
Gotcha.
Got it. I'm paying annual, I'm collecting monthly. Mm-hmm. Yeah. So the next thing is, let's show the value, Kevin, of 0% interest. So let's just take the first one, okay, and go down through that, and you kind of start seeing what happens, okay? So that term is 20 years. I know it doesn't say 20, but that's what it is. And if you did it at 8% interest, Kevin, then it would be like it would be double the payment. Okay.
Right.
So the savings is basically going to be 900 and something bucks. What's that number, Kevin?
$969.68.
So because we did it at 0 interest versus a more typical owner finance interest rate, we doubled our profit, so to speak, because we lowered our debt service by that much.
Mm-hmm. Okay. Yeah, both those terms, I apologize, and I will go back and fix that. Both those terms should be 20 years. So you're just comparing 0% interest loan to if you paid 8%. I mean, that's a heck of a savings on a monthly basis.
So that just sort of shows the power of buying with owner financing, with buying on terms, right? Now, we bought this at slightly below market. I'm going to tell you that. But we could have paid market price or below market price with this kind of math and still made money. Okay? All right, so let's look at this deal. Let's talk about it. How are we going to make money with this deal? Well, we like to say in terms of buy it by the case and sell it by the bottle. Okay? So this property bust up really well into about 6 tracts. About 500 feet wide and 2,000 feet deep. And Kevin, there's 6 of those, okay? So people say, what's the dimension? So a good rule of thumb in breaking up land is it can be 1 acre wide, Kevin, and 4 acres deep. 1-to-4 ratio. Okay? And that's a very common way to sell smaller tracts. These tracts are going to be slightly bigger than about 23 acres apiece. Okay? And it literally, Kevin, I didn't even go to the brain damage trying to lay all the plat down and all that stuff. It's shaped not too far from this.
No kidding.
Right? Yeah. And all of them are going to have saleable tracts. There's nothing too weird about any of them. Some of them are a little higher, some of them are a little lower, but they're all going to be saleable tracts. Now remember, we don't have a mortgage on all this, right? So that portion is released. Kevin, we have the advantage of selling those tracts for cash. Okay? We could sell those tracts for cash. And why would we sell them for cash? Well, we could get our down payment back times 2. So I didn't model it of selling them for cash because I kept everything consistent with seller financing, but the reality is we may sell them for cash, and we got $140,000 in it, and we could get about $280 for those tracts. So the land will sell for about 50 on smaller tracts. It'll sell for about $5,500 a piece. They're about 23 acres, so each tract sells for $126,305. Kevin, if you work in you and your wife work in a business in Fort Worth, Texas, and you drive a town truck that's a 4-wheel drive pickup, and you like going to the country on the weekend, you can own 23 acres of land, and your cost of that is $126,000. Okay, and there is a gigantic amount of people. You live in Orlando, I live in the Dallas area, but there's a gigantic amount of people that love going to the country on the weekend.
Yeah, absolutely. That's a big thing. And how far? I mean, this wasn't that far out either. I mean, it's a great location as far as convenience too, right?
70 miles from downtown Fort Worth. Yeah, you can leave the highest building in Fort Worth and be at this property in 70 miles, and that's, believe me, for country weekend land, that's good. So there's a lot of people that are going to want to do this and keep it, and live on it.
Right. So you sell these first 2, and you essentially now have no money in this deal as well.
Yeah. Now I didn't model it that way, but I'm not saying that may not be what happens. No, if we sell the first 2, we double the down payment. I mean, we get twice the money we paid down. So this is per tract. We own or finance them. There's 6 tracts. So this property's gross sale, Kevin, is $757,680. Okay, we bought it for $371, and we sell it for $757. Okay, and I've got that math up here. There's a lot of math in this, and we're going to offer to give you the slides at the end, by the way. Okay. Now we're going to get a good down payment if we sell these things. So we're going to get a down payment of 25% per tract, $31,587. So we're going to get about $190,000 down. We have $140,000 down, and we're going to get $190,000 when we sell them. So people say, how do you recoup your initial investment? It's on the front end because we're going to owner finance them, and they're going to pay us 25% down. We're not asking for 40% down like we paid. We're asking for 25%, and that's a very marketable number. By the way, these people that are borrowers, these people are like people that want to buy a weekend property, and their economic profile is much different than maybe like selling another property to somebody that's going to live in it that's just trying to buy affordable housing, right? These people's probably primary residence is not affordable housing. Okay, so we sell it. We got a loan. We're going to sell it $126,350. We're going to carry a mortgage for them for $94,762, and they're going to pay us the $31,587 down. We're going to carry that paper for them at 20 years, owner finance, and they're going to pay us 25% down. Now, let's roll forward and see what we got, Kev.
All right.
There's the note that they're going to sign to us. They're going to do a $94,762 note. We're going to carry it at 8% interest, payable over 20 years. Monthly payment, $792. All right. So we're going to do this 6 times, right? So there's the note that we have. That's the note that we owe the lady we bought it from. Now we're going to carry 6 notes, and these are wrap notes. Now technically 2 of them aren't wrap notes, right, Kevin? Because she released the property, right? But it's okay. I just didn't try to get it. I didn't try to make it more complex. So just figure these as wrap notes. So we owe the left side of your screen, and we are owed the right side of your screen. So let's progress and see what that looks like, Kevin. This is our cash flow we're receiving every month. The life of this loan pays back $190,000 a note. Plus they paid a $31,000 down, right?
Right.
So we take the monthly payment, we multiply it times all 6 tracks. That's our gross income, Kevin. $4,755 is our gross income on those 6 notes. Now we have an underlying debt, don't we?
Absolutely.
All right, so let's figure that out. So there's our gross income. We have divided the annual payment into 12 so that we have properly calculated our debt service to the lady that sold it to us. And per month, we're going to net $3,793. So remember the math, Kevin? Yeah. We bought it 140 down. We're going to get about 190 down when we sell these tracks. Then we get $3,793 for 20 years.
That's good looking stuff.
And so here's kind of, so number 1 shows so David and I's debt service, and then number 2 shows the wrap notes that we have and what we're collecting. Now technically, as we said, a couple of these deals aren't technically a wrap because it's released, and there's other ways to carve this up, but this is a business that David has done many times. He's been my partner on other stuff for years. And just reminding you, I just lumped in the monthly payment, Kevin, on the annual payments. I just divide them by 12 so that the math would flow. Okay.
Sure.
They're really not due until the end of the year.
Right.
At 0% interest, of course.
Well, of course.
All right.
Yeah.
Pretty fun, huh? So that's our gross down payment that we're going to get on selling the tracks there. And then that's what we paid down. And then so we're going to net close to 50 grand up front. And then obviously we're going to get a net monthly payment. If you multiply that time the life of the loans, that thing's grossing out close to $1 million, Kevin.
Yeah. Huh.
That's the real math. Now, I'm not saying it's $1 million today, but I'm saying it equates to $1 million over time. And this is the thing that I want people to realize is Note School's biggest focus is teaching you financing strategies that are wealth strategies, right? This is a wealth strategy. All right, there's your net monthly payment that we're going to get after what we paid down minus what we get. So then that shows the payments received, and you're scaring the heck out of $1 million. $959,842 is the total of those two. The first one is the difference in the cash down payments, what we paid and what we received. The second one is the monthly payments we received over time. Okay. So our profit after cost, it's $588,592. That's a double your money deal, Kevin.
Sure is.
And this is kind of a formula. I mean, this is kind of a formula that, and once again, this is a real deal that I do, and I do more of these, and I showed it but some of you think, well, that only worked because it was land. That's not true. This will work no matter what the collateral type is, right, Kev?
Mm-hmm. Yeah, I know the math can look a little complicated through some of this, but you know, if we kind of take a higher view back on this one, it's really the strategy that you're utilizing here, right? It's buying on terms, and then it's selling on terms, and of course, as a part of that, you also have to know real estate and how do we evaluate it and think in terms of highest and best use, right? So I mean, the technique is exactly as you're saying. It could be applied really to anything.
Yeah. This math, Kevin, says the gross sales price that we sold it for, and I think we're selling it for top dollar because we're offering owner financing, right? Mm-hmm. But this assumes we sold all 6 tracts for cash, and it just takes out our cost in it had we paid all cash for it. And so it would have been a profitable deal to reposition this land, right? But I will tell you 2 things. I don't think we would sell those tracts for the same money if we sold them all for cash, and then it makes $386,000. The other one makes $586,000. That's not exactly the number, but you're like, wow. So the big part of the profit in this deal was not just buy low, sell high, right? Not buy land, bust them up into smaller tracts and sell them. The money in this deal was the financing.
Right.
So that's, you look at the comparison, I mean, which one would you take?
I just have, my eyes are drawn to that bigger number, I think.
So once again, we realize there's a lot of numbers on this, but in order to tell the story, we had to kind of take you through the process of how we analyzed it, how we bought it, how we sold it, you know, and what that looked like. All right, Mr. Kevin. This is the most important part, what we learned, right? So the pop quiz here is math other than buy low, sell high, and I think that became super evident in this deal, that this is way more than just buy low, sell high. And next one. Now you can see why being the bank is so good. On the buy side, we bought on really soft terms, 0 interest, okay? But listen, we did pay a big down payment, didn't we, Kevin?
Absolutely.
But we had a strategy of how we were going to get our down payment money back, which was when we resold the tracts, we were going to get a down payment when we resold them. So we didn't just get our money back, we made about 50 grand up front, and then we ended up just riding the leverage in this deal, a 0 interest, and all of a sudden you start seeing, you know, who wouldn't like to do one deal that paid basically just under $4,000 a month in net income for a long time, right?
Right. With just one big annual payment. Once again, we were showing monthly, but really, just everybody remember that's just one annual payment going out. So you're collecting money for 11 months, let's say, and then you only have to pay out once. And heck, you go back and look at those numbers. I mean, that's.
Oh, by the way, when we bought this, Kevin, we bought it in a corporate entity with no personal guarantee. So the last one, Kevin, is more creative than. And I would say, if you're not familiar with this thinking, you think, wow, this was so creative and whatever. And Kevin, when they come hang out with us at these classes, this deal's not going to look much different than another tomato, is it?
Right. It comes down to knowing how to create notes when you're selling property, but also how to negotiate notes and offer terms to people when you're buying property. And having, that's really on this one what made the big difference in the profit margin. It was a massive amount of difference on that because you did it on both ends. You had the creativity on both sides. Again, it much more different than the very simple, well, I'll try to buy it at this price and then sell it at a higher price. Yeah, somebody could have made money on that, but I mean, we have case studies that I've got a couple running through my head right now that we show on single-family homes that have done the same thing. And you know, they just went from one technique to another, and all of a sudden, instead of just flipping a property, now they had that creativeness where they made, you know, 5 times more money or more than they would have made if they just did a simple flip. So there's no question, in, you know, in the marketplace today, the creative thinkers, the people who are architecting these deals, the people who find out what the sellers want, what they need, and satisfying that with a game plan on how to exit out, those are the ones who are really crushing it in this market.
Yeah, and quite honestly, you can, I know in a 3-day class, Kevin, you can go take this deal into a few what ifs. Like, let me take a wild guess. Do you think that lady that wanted the $140,000 down and is getting $12,000 a year in payments, or $11,500, do you think she might want another bigger lump sum of money down the road? You think that's a possibility?
Yeah, in other words, you know, that lump sum was good, and all of a sudden the $12,000 a year sounded good, but something in her life changed, and boy, I wonder if we could go back and ask for more money from those guys I sold the land from.
Yeah. So we probably could structure a deal down the road. The opportunity will probably present itself to buy some stream of payments for her at an additional discount, and then we could talk about how we could raise the money to do it by buying some of the stream of payments that we're receiving payments on. It's just endless, Kevin, as to where this story goes. So we realized there was a lot of numbers on this deal, but the reality is the numbers became the story. And as you said, Kevin, we've got a number of case studies that are on more traditional houses and other property, but we thought this was a good little picture to tell, and basically something that I'm actively doing a lot, and we definitely think it's a fair statement to say that buying property with seller financing is a niche that everybody should be trying to do.
I agree, and of course, you offered the presentation to them, and we've got an email all set up for that, info@noteschool.com. If you'd like a copy of the presentation or YouTube link to the presentation, you can email us, info@noteschool.com.
Yep.
And then, of course, we also have some classes. And as you mentioned, Eddie, I'm the lead instructor on these classes, and as you said, we take things at this class to such a higher level, but we teach it in a way that builds up to it. We don't just, you know, throw out a bunch of stuff. No, there you go. It's really a building process where we can get people up to not only what we just went through here on this live webinar, but as you said, take it to another level, saying, well, what if she did want more of a lump sum? What would we do? What are some of the alternatives on there? And we get out the calculators and we go through the whole thing. So it really gives us time in these 3 full days to drill down on everything that we need to. And we've got the website there, noteschool.com/classes, and then you can also call us, 888-980-9240.
Yeah, these classes, and that's what, when you click that site, here's what it's going to come to, and it's going to have potential. You're welcome to call us if you're ready to sign up and go to a class. We're going to have a good many classes left here this year, so there's plenty of options of what those can be. And so when we start the class, just to give you guys a little bit of sense of it, we take all of these different niches and notes, and we say, we want to slow this down for each of these niches and look at what this looks like. And as Kevin said, it's really easy for us at a class to go say, okay, well, Eddie bought this land, Eddie and David bought this land, they paid this down. What if they'd have paid a different amount down, right? What if they'd have paid more down? What if they'd have paid less down? What if she only agreed to 2% interest and not 0% interest, right? Or what if, they took this land that she released and just somebody came along and said, I'll pay cash? What does that do to their financial model, right? And so you start really realizing, people think, well, if I'm going to buy property and do this, there's no way I'm going to end up with any quick income out of the business. Well, in this deal, we could end up with quick income. We could make $150,000 selling that land that she released. We could sell that for just a tick over $300,000.
Sure.
Then all of a sudden we'd have the rest of the land left that we could go do something else with, and obviously owner financing and carry it over time. So there's a lot of different ways once we get a sense of what you're trying to accomplish as to saying, okay, how do we accomplish that? And that really is the magic of, Kevin, being in that class and the environment in the class and getting to know students and some of their stories. It's not just a one-size-fits-all shoe.
Yeah, exactly. And it's not all, as this illustrated, it's not all just single-family homes. We go through all different types of properties, because once you do know the techniques, you do know the proper setup, well, heck, you can adapt that to any kind of real property.
Yeah, absolutely. And there's different scenarios. I've been heavily involved in a lot of dirt transactions like this, country land I call it, and most of them weren't necessarily close to where I lived. I was kind of the deal architect, and I would go find a local operator that was good at finding the land and selling the tracts, riding people out there, showing them the land and that kind of thing. And I really ended up in a number of partnerships over the years where I was sort of the guy that put the math together and showed them the strategy of how to do it. So those are all possibilities as well. You don't have to just do houses, and it doesn't have to be just in your backyard.
Yeah, I don't have much that nice hilly property that you were showing in my backyard, Eddie, for me to buy.
I'll tell you something. I did a dirt deal not very far from you in Lake Cities, Florida, and it turned out to be a heck of a deal. So it definitely can be done down there where you are.
No, I mean not many hills. We don't have too many hills down here in Florida. I don't have those little mountains that y'all got there.
Well, I think our friends in Montana would object to that, by the way.
Yeah. No, that definitely can be done here, but not going to be hill property, but good property. No, I agree. So really good stuff, and thank you, Eddie, for the case study. Any closing remarks?
This is fun. Kevin, you and I've done this a lot, right? We're practiced presenters. We've done it many hundreds or thousands of times, but I will tell you, it never stops being entertaining to see somebody when the light bulb turns on and something that they just hadn't thought about before, or somebody hadn't quite presented it to them in a way that connected, and then all of a sudden it connects, and just to see that their face light up is just, that's always been entertaining, and it's just as entertaining every time I see it as it ever was in the early days of it.
Absolutely.
You guys have a great day. Yeah, we look forward to seeing you somewhere, seeing you at a class, and we're going to give you some good homework before you get there, and we'll give you some. We'll go through a lot of scenarios like this and slow it down enough to make sure that you're following the math, but slow it down so you can do it. Don't forget, if you'd like a copy of this presentation, we'll have it on YouTube. You can just click the link and watch it again, as well as we'll be glad to send you the PowerPoint slides.
Sounds good. Thank you, Eddie.
Thanks, Kev.
You bet.
Bye-bye.